What's up, everybody? It's Professor Reiko. Today we're going to start talking about Treasury stock. So we're continuing on in our stockholders' equity section. Now we're switching gears from common stock to talk about Treasury stock. So what is Treasury stock? All right, Treasury stock is when a company goes out and buys their own shares to hold. All right. So important thing to remember here: it is not an asset. Okay, because it's inappropriate to apply. A company can own part of itself. It actually reduces net assets. It is a contra equity account. Okay, meaning so we'll still debit it because it's a contra equity account. And sometimes students feel like, well, if we're going out and buying something and we're debiting that account, it does feel like an asset, right? But remember, it is a contra equity account. It's subtracted in the equity section of our balance sheet. All right, so Treasury stock, I says, when companies go back and buy back their own stock, there's a number of reasons why they might do that. Your book lists out some, a couple or more tax efficient distributions, meaning if they're buying back their own stock, typically the stock price will go up, and so their shareholders can sell and pay capital gains taxes as opposed to paying dividend if they pay out a dividend, paying the tax on a dividend. They a lot of times will buy back Treasury stock to hold and then to compensate employees through restricted stock awards or stock options or things like that, which is something we'll talk about in the earnings per share chapter. All right, so let's get into the accounting of it. So we're going to use the cost method, which is the most common method used. All right, so what's going on here? First thing we need to do is have shares that are out there that are issued and outstanding so that we can buy them back. So this is just like the first part of the chapter, the first couple of videos, all right? We're just issuing stock for cash, okay? So this is what your journal entry looks like. So remember, we debit cash for the issue price, which will be $150,000. We always credit common stock for par value, so that's $10,000. And then everything else goes as additional paid-in capital account. All right, so something I'm going to do, I don't know if your teacher does this or not, but I'm going to keep up with the issued and outstanding shares, okay? So in the very first video, we defined these. Issued means they've been sold or issued, which is this case, we just issued 10,000. Outstanding means they're still in the hands of shareholders, which in this case, we sold them and they're all still in the hands of shareholders. Now remember, anytime there's a difference between these two numbers, the difference is the number of treasury shares that we are holding. Okay, at this current point in time, we have not bought any back, so therefore it's that there's no difference between those two numbers. All right, so now we're going to go back. It says we reacquire 1,000 shares of treasury stock. So it means we go out and buy our stock, we hold it, and we buy it back. We call it treasury stock at $40 per share. Now look, we're using the cost method, so this $40 right here is going to become our magic number for treasury stock the rest of the way. All right, so we're debiting treasury stock. And remember, we debit treasury stock not because it's an asset. We debit it because it's a contra equity account. All right, so we bought 1,000 shares at 40, so that is 40,000. And we're just paying cash, so it's 40,000. Notice I don't do anything with my common stock account or anything like that. We leave that alone for the time being. All right, so issued and outstanding. Now look, there's still 10,000 issued. But now only 9,000 are in the hands of shareholders because 1,000 of them are now being held by us as treasury stock. All right, so now you can see the difference there. It's off by 1,000, but that's correct because we have 1,000 shares of treasury stock. All right, so now we're going to sell some of them back. Okay, so we're selling 200 of those 1,000 shares back into the open market at $50 per share. All right, so we're going to sell them. So remember, the cash is just what we sold them for. So we sold 200 at 50. Okay, so that's $10,000. Skip a space here. We're going to have treasury stock, and treasury stock is we're selling the 200 shares. Now look, we account for these at that original cost, which was 40. Okay, so that is the 8,000. All right, so we can see we need 2,000 here. All right, so a common mistake is students will sometimes say to themselves, all right, I bought something here for 40, and then I sold it back for 50, so I have to have a gain. Okay, but remember, gains and losses deal with kind of us buying and selling our assets. Remember, treasury stock is not an asset. All right, so we're not recognizing a gain. We're just increasing our equity. All right, so it's a paid-in capital account, so paid-in capital for treasury stock. So I just call it additional paid-in capital treasury stock. All right, so now the issued number an outstanding number. So remember, issued still has not changed. Now look, just make a mental note here. The only time issued shares change is when we issue more, which was the very first journal entry, and then when we retire shares, and that's what we'll do at the bottom of the page. All right, outstanding. So outstanding was 9,000, but we just sold 200 back. So now there's 9,200 shares that are out in the open market in the hands of shareholders. All right. So let's scroll down here. And so now we're going to continue selling some back. All right. Now I've kind of divided the page here. So I'm just going to do this. And actually that will continue all the way down the rest of the page. All right. So let's do the side B first. All right. So we're selling 500 more shares of Treasury stock back. And on the right-hand side here, it says we're going to sell them for $39 per share. All right. So we know how to handle this. Cash, remember, is just how many we're selling times the sales price, which is 39. All right, so that is 19,500. Skip a space here. Treasury stock is 500 shares times the $40 originally cost, so that's 20,000. All right, so you can see here we're off by 500. Okay, so anytime I'm doing a treasury stock problem, I will start keeping up with this T account. Additional paid-in capital treasury stock. All right, so in the very first journal entry, not the very first journal entry, but this entry right here, we put 2,000 into it. All right, so I'm going to go on and write this out on this side as well. Additional paid-in capital treasury stock, because these are going to basically be two separate things going on here. All right, so they both have 2,000. All right, so looking over here on side B, all right, so the rule for this account right here is I can debit this account. It just can't end up with a debit balance. Okay, so you can see here in this one, I'm off by 500. So I can debit this account by 500 and make it 1,500. I could not debit it for more than 2,000. Okay, so additional paid-in capital, I just reduce it by the 500. I'm good. Okay, so once again, I can debit additional paid-in capital treasury stock. I just can't make that account end up as a debit balance. Because if you think about it, I mean, it's an equity account. It's a normal credit balance. It's additional paid-in capital. If it ended up being a debit balance, you'd be like you were saying, you have negative additional paid-in capital, which doesn't even make any sense, right? So let's go over to this side now. All right, so now we're still selling them. So we get cash for the sales price. So 500 times $34 in this example. All right, so that's 17,000. Skip a little space here. Treasury stock is still the 500 times the $40 per share. Okay, so that's still 20. All right, so now if you look here, we're off by 3,000. Okay, so this is where this comes into play. Once again, I cannot debit this for 3,000. Okay, because it'd end up as 1,000. So I can't do that. But I can debit this for 2,000 and it just zeroes out the account. All right, so I have additional paid-in capital. So I'm reducing equity by this 2,000. But I'm still off by 1,000, right? So here I'm just going to reduce retained earnings by 1,000. So that will be my additional reduction to make that balance out. So make sure you see the difference between those two, all right? I'll say it over and over again in the class. You can't have the additional paid-in capital account end up as a debit balance. And it never fails that some students will end up, like in this example right here, they would just do it all for 3,000, okay? And that would be incorrect. So make sure you make a mental note of that so you don't make that same mistake. All right, now retiring shares. All right, so when I think of retiring shares, I think of it, actually, let's go back up here. I forgot to do issued and outstanding. All right, issued and outstanding would be the same on each side because it was 500 shares. All right, so let's think about that. Issued did not change. It's 10,000. Okay, look up here. It was 9,200. Now it would be 9,700 because we sold 500 back. And look, that makes sense because we still have 300 shares of treasury stock. All right, so we still have 300 shares of treasury stock left, and that has to be the difference between those two numbers. All right, now retiring shares. All right, so when I retire shares, the way I kind of think about it is I think of it as I am unissuing it. So unissue. I don't even know if unissue is a word, but that's the way I think of it. All right, and the reason I think of it that way is let's go back up here to the top here. All right, this journal entry out here was us issuing the common stock. All right, so notice when we issued the common stock, we had these two credits. If I'm going to unissue those, I need to debit common stock and additional paid-in capital for how many shares I'm retiring. All right, so looking up back here, remember this par value represents $1 per share. We sold them for 14, so the additional paid in capital was $14 per share. That makes sense. So the 1 plus the 14 is the 15 total sales price. All right, so I need to know those numbers because I'm going to, when I take these 300 shares I'm retire off the books, I'm going to do it for those amounts. Okay, so let's scroll back down here. All right, so I kind of break this up into 3 steps. All right, so step 1 will be to unissue the common stock. All right, step 2, take off treasury stock, meaning take it off the books as well. And then step 3 is just clean everything up to make it balance, right? So what am I going to do? Step 1, unissue the stock, all right? So step 1, I'm going to debit common stock and debit additional paid in capital common stock for the original amounts up at the top of the page, meaning the par value was $1, so this will be 300 times $1, or 300. And then this will be 300 times $14, which will be 4,200. I got a little small there. Sorry about that. That's step 1. Okay. And that's going to be the same on both sides, but we'll do side B here in a second. All right. Skip a space here. Step 2 is to get rid of the treasury stock. All right. We're still using the $40 cost. So 300 times the $40 original cost is $12,000. All right. So now we can see we have a difference of $7,500. Now look. If we had any of this additional paid in capital, let me scroll up just a little bit. Notice this account up here, that is zeroed out. So we have no additional paid in capital treasury stock left to use. So step 3, when we're cleaning it up, it's all got to come out of retained earnings. All right, so that cleans up that journal entry. All right, on this side over here, step 1, we're still going to do the common stock and additional paid in capital common stock for the 300. And the 4,200. So that is us taking those 300 shares off the books. All right, skip a couple spaces here. Step 2 is still to get rid of the treasury stock, and that would still be at 12,000. All right, however, now in this example, notice up here, we still have 1,500 left in that treasury stock account. So I can debit that account for 1,500, all right, meaning additional paid in capital treasury stock for 1,500. And that zeroes that out, and then the remaining 6,000 would go to retained earnings. Okay, so that'd be step 3, just cleaning things up. All right, so I like doing these side by side so you can see kind of the difference of when we run out of additional paid in capital treasury stock and how we switch over to using retained earnings after that. All right, so this is a pretty good example of treasury stock from start to finish. All right, so this is kind of, as you can see, this is a longer video than the other few that we've had so far in this chapter. So this is something you should really expect to be able to do on the test. It's a good candidate to be either the entire problem if your teacher does big problems or part of a bigger problem. So just make sure you can handle this. Most problems will start, let me scroll up by, creating, here you buy it back, and then here you sell it for more to create that additional paid in capital treasury stock. And then you start eating away from that. Now look, in this journal entry right here, if we would have sold it at some number below 40, meaning below the original cost, we just would have had to go ahead and credit retained earnings because there wouldn't have been any additional paid in capital treasury stock yet. So that's about the only thing I could really switch up on it as far as the a normal problem goes. All right, so the next video I'm going to do is just another treasury stock example similar to this. So I think it'll be a good idea to tune into that. Oh, and one thing I forgot real quick down here at the bottom. All right, issued and outstanding. Okay, I almost forgot this, and this is important. All right, now look, remember at the top I said the only thing that affects issued and the only thing that affects issued stock is issuing more stock or retiring stock. Okay, so the issued number has now, we just retired 300, so that goes to 9,700. Okay, so we were up here at 10,000 and 9,700. All right, now this is where some students get confused. The outstanding number has not changed. Now look, we retired 300 shares, but we did not put them back in the hands of the shareholders. We just kind of put them back into our authorized pool of shares. All right, so sometimes students want to subtract the 300 from outstanding, but remember, we have no treasury stock left, so these numbers have to be the same. Another thing to think about is if we subtracted them here, so if you look up here, when we originally subtracted the 1,000 shares, that 300 shares that we just retired were part of this 1,000 shares that we originally bought back. So we already subtracted it right here. right? So if we would have subtracted down here at the bottom, we would have double counted that. So make sure you make a mental note of that. I almost skipped over that, which would have been bad. But make sure you see that we're now at 0 treasury shares. So those numbers have to be the same. Okay. All right. So hopefully this helps. I'm going to do another one just like it on the next to really drive home all our issues with treasury stock, and hopefully you'll have a good grasp after watching this video and the next video. All right. So I hope you're enjoying. Please subscribe to the channel and share with your friends, and hopefully it will help them as well. I'll see you next time.